Welcome back to the channel. Your James Ag here. If you're seeing this, it means we made it through the week, and I need you to understand something critical before we dive into the data. What happened in the last 72 hours wasn't a market correction. It wasn't risk-off sentiment, it wasn't algorithmic repricing, it was a liquidation event, scripted, coordinated, and executed with precision. I'm going to walk you through exactly how they set the trap on Tuesday, sprung it on Thursday, and executed the demolition on Friday. We're looking at a $10 trillion wealth transfer that happened in 6 hours, designed specifically to separate physical metal from weak hands and protect a fiat system that's showing structural fractures. But before we get into the COMEX inventory anomalies, the Shanghai-Tokyo physical premiums, and the margin warfare that decimated the leveraged longs, I need to lock down something essential. Listen carefully. There are predators crawling through the comment sections and social feeds right now, especially after a volatility event like this. I will never send you a direct message asking for money. I will never ask you to join a private WhatsApp group, a VIP Telegram channel, or a paid signal service. I do not manage capital. I do not sell courses. I do not offer investment advice. If someone claiming to be me or using my profile picture with a slight name variation contacts you asking for payment, cryptocurrency transfers, or exclusive trade setups, block them immediately. Report them. They are scammers exploiting fear and greed. This channel is educational. I am a macro analyst, not a financial advisor. Nothing I say here constitutes a recommendation to buy, sell, or hold any asset. You are responsible for your own decisions, your own due diligence, and your own risk management. Now, I need to know who's actually here. The algorithm is suppressing precious metals content right now. Surprise, surprise. So if you're seeing this in your feed, you're part of a very specific cohort that's searching for truth in the noise. Do me a favor, drop OG in the comments below. Not for engagement farming, but because I need to filter the real community from the bots and the tourists. OG tells me you've been here, you understand the distinction between physical and paper markets, and you're not here for hype. Second, tell me your location and your local physical premium. Are you seeing disconnects between the paper spot price and what your local dealer is actually charging? I'm hearing reports of $150 silver in Tokyo, while the screen shows $84. I want to know what the ground truth looks like on your end. This data matters more than any chart I can show you. Let me be direct. This video is not for everyone. If you're looking for price predictions to trade on margin, close this now. If you want moon memes and $500 silver by next week, you're in the wrong place. If you're looking for confirmation bias to leverage your position to the hilt, I will disappoint you. This content is for serious, independent thinkers only. For people who understand that gold and silver are not trading vehicles, they're strategic assets, national security inputs, wealth protection outside a system that's currently demonstrating exactly why you need that protection. We're going to cover the mechanics of how they crashed the paper price by 40% in 6 hours while physical metal disappeared from vaults. We're going to look at the CME margin warfare, the Warsh appointment timing, and the repo facility anomalies that suggest this was choreographed down to the hour. But we're going to do it with discipline. No hysteria, no guru speak, just data, structure, and the uncomfortable realities of how paper markets are used to manage sentiment in the physical world. So if you're still here, you're part of the minority that recognizes something fundamental. When they attack this hard, this fast, with this level of coordination, it's not because precious metals are weak, it's because they're terrified. Let's get into the dislocation. Let's talk about Friday, January 30th, 2026, not the news cycle. Not the headlines, the mechanics. At 9:47 a.m. Eastern, silver traded at $121 per ounce on the COMEX, a nominal all-time high, following gold's breach of $5,600 just 24 hours prior. Retail flow had reached historic extremes. The iShares Silver Trust had absorbed $171 million in a single session. Social sentiment indicators were euphoric. The consensus trade, weak dollar, strong metals, seemed unstoppable. By 3:30 p.m. Eastern, silver was trading in the low 80s. That is not a correction. That is an execution. 40% of nominal value evaporated in 6 hours. The ProShares Ultra Silver ETF, ticker AGQ, shed 60% of its market capitalization before circuit breakers could catch the debris. Gold, despite its safe haven narrative, hemorrhaged 15%, plunging from $5,600 to $4,700. But here's the dislocation, the fracture in the narrative that you need to understand before we examine the policy triggers. While the paper price on Western exchanges was collapsing, physical silver in Shanghai was trading at $122 per ounce. In Tokyo, dealers were quoting $150. Let that register. The paper screen showed $84, while physical metal changed hands in Asian markets at a 44% to 78% premium. Why is the price crashing in New York while it's rationing in Shanghai? This is the question that breaks the illusion. In a functioning market, arbitrage closes gaps. If silver is truly $150 in Tokyo, every ounce available at $84 in New York should disappear instantly, shipped east until equilibrium restores. Instead, the spread widened. The COMEX registered inventory, the metal actually available for delivery, stagnated while 531 tons of paper contracts traded hands in Shanghai. 531 tons traded. Zero physical withdrawal from vaults. The system decoupled. The paper price became a fiction, a managed reference point disconnected from the physical reality of supply. And the timing? Surgical. The crash occurred on the final trading day of January. This is not random. We saw an identical 15% gold decline on the final trading day of December 2025. Both dates coincided with record utilization of the Federal Reserve's repo facility, the emergency lending window for primary dealers who happen to carry massive short positions in precious metals futures. Ask yourself, why does the paper market break specifically at month end? Why does the Fed's repo facility spike precisely when metal shorts are underwater? Why do margin requirement hikes, 4 in 6 weeks preceding this event, totaling an 80% increase, always precede these organic sell-offs? The dislocation is not in the data. The dislocation is the data. We are witnessing a bifurcation. The East is treating silver as a strategic asset, stockpiling, rationing, paying premiums, while the West is treating it as a sentiment derivative to be weaponized against leveraged speculators. The paper price is no longer a discovery mechanism. It is a management tool, and Friday's violence was the most aggressive demonstration of this divergence in modern history. When paper falls 40% and physical tightens simultaneously, you are not watching a market. You are watching a firewall, a deliberate destruction of paper value to protect a currency system that cannot tolerate alternative stores of wealth gaining traction. The question is not whether you should buy the dip. The question is, which price is real? The $84 on your screen or the $150 required to actually obtain the metal? Because one of those numbers represents a market, the other represents a trap. Let's dismantle the machinery. To understand why a 40% crash in paper price coincided with physical scarcity, we need to examine the institutional plumbing, the actual data flows that govern delivery, leverage, and settlement. Start with the COMEX inventory structure. As of the Tuesday before the crash, registered silver, the metal available to satisfy futures contracts, stood at approximately 45 million ounces. Eligible metal, stored but not available for immediate delivery, brought total warehouse stocks to roughly 300 million ounces. Here is the critical ratio, open interest versus deliverable supply. On Thursday, January 29th, silver open interest on COMEX exceeded 1.4 billion ounces. That represents a leverage ratio of roughly 31 to 1. For every ounce of registered metal available for delivery, there were 31 paper claims trading in the derivatives market. This is not a market. This is a synthetic leverage instrument masquerading as price discovery. When the CME Group raised margin requirements 4 times in the preceding 6 weeks, an aggregate increase of 80%, they weren't managing risk. They were engineering a liquidity trap. Each hike forced leveraged longs to post additional collateral or liquidate. By Friday's close, the exchange raised margins again, ensuring that any bounce would face immediate selling pressure from traders unable to meet maintenance requirements. The result? A $10 trillion wealth evaporation that transferred paper claims from retail and speculative accounts to entities with sufficient cash reserves to absorb the margin calls. While New York liquidated paper, the Shanghai Gold Exchange told a different story. The SGE premium, the spread between the international spot price and the actual clearing price for physical delivery in China, exploded to $38 per ounce for silver. Gold premiums hit $45. More tellingly, the withdrawal data. On Friday, while 531 tons of silver contracts traded on the Shanghai Futures Exchange, physical withdrawals from SGE vaults dropped to zero. This is the smoking gun. When prices crash in a genuine liquidation, physical buying accelerates as value hunters acquire metal. Instead, Shanghai participants traded paper derivatives while holding physical positions off the market. Simultaneously, the Shanghai Futures Exchange raised margin requirements on silver contracts by 12%, effective immediately. This mirrored the CME's strategy, but with a crucial distinction. Shanghai's move occurred at the precise moment of maximum Western selling pressure, removing the bid that typically provides a floor during COMEX declines. China did not just exit the market, they stepped aside to let the West destroy its own leveraged participants. The CFTC's Commitment of Traders report for the week ending January 28th, released just hours before the crash, revealed a stark divergence. Managed money net longs had reached historic extremes, exceeding 75,000 contracts in gold and 65,000 in silver. The commercial category, predominantly bullion banks and swap dealers, held record net short positions. This positioning explains the velocity of Friday's decline. When the Warsh appointment announcement hit the wires, reversing Tuesday's weak dollar signal, the commercial short cohort had already positioned to cover into forced liquidations. As margin calls triggered stop losses below $115 silver and $5,400 gold, the commercials bought back shorts at accelerating speeds, locking in profits while managed money accounts hemorrhaged equity. It was a classic short squeeze in reverse, a long squeeze executed with the precision of a banking operation. The Silver Institute's latest supply-demand data, though lagging, provides essential context. Industrial demand driven by solar PV manufacturing and AI data center construction is projected to consume 1.2 billion ounces annually, against mine supply of roughly 850 million ounces. The structural deficit, approximately 350 million ounces, is being filled by above-ground stock drawdowns. MCX India data corroborates the geographic divergence. Indian silver imports, typically price-sensitive, surged 340% in January despite the rising nominal price, indicating that Asian manufacturing and investment demand treats Western paper volatility as noise rather than signal. Finally, the month-end pattern. Both the December 2025 and January 2026 crashes occurred on the final trading day of the month, coinciding with spikes in the Federal Reserve's overnight reverse repurchase agreement facility utilization. When primary dealers who carry the massive short books in precious metals face quarter-end and month-end balance sheet constraints, the repo facility provides the liquidity to maintain those positions. The correlation suggests coordination, not coincidence. The system requires periodic liquidations to prevent the paper leverage from reaching critical mass where delivery demands could not be satisfied. Friday's crash reset the open interest-to-registered ratio from 31.1 to a more manageable 22.1, still dangerously elevated, but sufficient to prevent immediate delivery stress. The data is unambiguous. This was not price discovery. This was position management. Before we synthesize these events into the broader macro thesis, a brief technical snapshot is warranted, not as a trading roadmap, but as a diagnostic of the damage inflicted and the structural integrity of the price structure following Friday's liquidation. On the daily timeframe, silver's RSI plunged from an overheated 78 on Thursday to an extreme 16 by Friday's close. Deeply oversold territory not witnessed since the March 2020 liquidity crisis. Gold's RSI registered a similar collapse, hitting 22 on the daily while printing a 14 on the hourly chart during the panic window. Conventionally, these readings suggest exhausted selling pressure and potential mean reversion. However, in the context of the margin warfare we discussed, RSI becomes a measure of liquidation intensity rather than valuation. When an asset drops 40% in 6 hours with RSI buried below 20, it indicates forced selling, mechanical unwinding, not organic distribution. The indicator is signaling distress, not opportunity in the conventional sense. Price action violated every major moving average with predatory efficiency. Silver, which had maintained posture above its 50-day exponential moving average for 11 consecutive weeks, sliced through the 50 DMA, 100 DMA, and 200 DMA in a single session. The 200-day simple moving average sat near $88 on Friday. Silver closed below it, trading at $84, effectively breaking the long-term trend backbone that had supported the bull market structure since mid-2024. Gold's violence was equally acute but more contained relative to its trend structure. The drop from $5,600 to $4,700 pierced the 50-day EMA but found temporary mechanical support at the 100-day EMA near $4,680. However, the weekly chart, the time frame that matters for structural holders, printed a bearish engulfing candle of historic proportion, swallowing the previous 6 weeks of price appreciation. The Ichimoku cloud provides perhaps the clearest visualization of the trap's mechanics. Prior to Tuesday's Trump dollar comments, silver had maintained position above the Kumo cloud on both daily and weekly charts, with the Tenkan Sen conversion line above the Kijun Sen baseline, classic bullish posture. By Friday's close, price had crashed not just through the cloud, but through the lagging span, Chikou span support, dating back to October 2025. More significantly, the Kijun Sen flatlined at $98, creating a magnet for price that was violated without consolidation. When price drops through the Kumo with the Chikou span breaking historical support simultaneously, the cloud ceases to function as support and becomes resistance. The technical structure suggests that any recovery faces dense overhead between $95 and $105, exactly where the bulk of the liquidation volume concentrated. The volume profile visible range, VPVR, reveals the anatomy of the slaughter. High-volume nodes, HVN, existed at $115 and $112 leading into Thursday, areas of prior consolidation where longs had accumulated. Friday's liquidation cascaded through these levels with volume spikes exceeding 400% of the 20-day average, indicating stop-run mechanics rather than negotiated selling. Most telling was the volume deficit between $100 and $90. Price fell through this zone with minimal transactional friction, a volume vacuum created by the margin algorithm's indifference to price levels during forced liquidation. The market profile shows a single print structure in the 80s, meaning minimal time was spent building value at these lower prices. This is the signature of an engineered move, not a negotiated equilibrium. I present these indicators not to suggest entry points or to imply that oversold equals buy. In fact, in environments where paper leverage can be weaponized via margin hikes and political timing, technical indicators become secondary to custody and structure. A 16 RSI can become a 12 RSI. A broken 200-day moving average can become a distant memory if the CME raises margins again. The technical snapshot confirms what the inventory data already suggested. This was a dislocation event that broke the chart. Technical analysis in such conditions serves as damage assessment, not prediction. The structure is fractured. Repair requires time, or alternatively, a recognition by the market that the paper price no longer reflects the physical bid. Now, having established the technical wreckage, we need to step back and understand what this coordination actually means for the system itself.